And David holds a Juris Doctorate and is also a chartered financial analyst and certified financial planner. So, David, if you could start this all off with something that I think is very timely, and that is basically to whom one should entrust one's money and in what sort of relationship should one engage that person. David?
Well, welcome, and I want to commend you for maybe taking a parenthesis right now out of the substantive areas of the symposiums that you're attending, and to, it's not working?
We check on that microphone up front, please.
Could you test? Is that working? No. Hello? 1, 2, 3. I will, okay. Let me try the auditorium voice and see if we can communicate that way rather than waiting for the microphone. What I mentioned was I appreciate you taking a parenthesis out of the substantive area of the conference and considering some of the issues in regards to investments and other issues such as insurance, to think about how you take your assets and income and reach financial goals. I've put in the presentation here a brief outline and a couple of graphics that I'd like to cover with you. But I'm going to take the title that I'm to address and maybe break that down a speaker's prerogative so that we could first look at just who should you have. So let's look first at Entrust. What's the taxonomy of that word? What do we mean by it? And then secondly, the who. Who is it that does this? And then lastly, I'll try and bring those two together in two major decisions for you. I'll propose two major decisions. But maybe as by way of an analogy, let's suppose that in your office comes someone that's referred to you as a patient with pain in the lower left quadrant. And now you start your process, examination. You would have some diagnostics run. You might then seek other specialists to give you input. I believe in a similar way, I propose that you would think about the financial area of your life and the need for experts and specialists to provide you information, but also, if you will, the balance that doesn't relegate your decisions to those other specialists, but rather you're only delegating issues that you need to get input from. I mentioned here, you're still the CEO, the third point, meaning that you can't relegate decisions to others. I think in my 35 years of experience, one of the most significant errors people make is either to try and capture the information and decisions without the specialist's input, and then also to use specialists as the decision makers. They're only informational sources. You have to, in your personal life, as I would contend in the professional life you live, you have to rely on others, but you still are the one making the decision. The second point I'd make is a bit of, I won't call it unorthodox, but certainly a trend in institutional investing that has evolved over the last 10 years, different from most of the MBA courses. You might have heard of things like modern portfolio theory, which is to look at different asset classes that one invests in and how they act one to the other, the returns and the volatility. What I'd like to propose is you start out with a relatively simple approach to determining what you should own, how you should approach your investments. Number one is for you to determine what you own. Secondly, what you owe. And subtract what you owe from what you own, you'll have your net worth. The second step, that creates a balance sheet. Now, the second step is to project out your income and your expenses, including in your expenses, things like capital expenses. It might be the purchase of a home, the sale of a home, purchase of another home, whatever that is out over time. Those are the expenses. And as you subtract expenses from the income, if there's a negative number, that's what either earned income has to generate, what your earnings are, or what your portfolio, your balance sheet is going to generate. And to the extent that there's a balance sheet piece, or sometime with retirement, there's going to be that need for these investments to earn some money, that will, we're here again, that will be the investment needs coming from your savings, from your portfolios. The reason I put it that way is it's important to understand when income is needed and how much volatility you can accept. By having that financial statement approach, you're very much like a corporation. You're going to extrapolate what kind of volatility and when you might need this money. Second step, so there's the financial statement, balance sheet, income statement that projects into the future. The second point I'd make is to provide yourself with a risk analysis tool, and I call it the risk allocation framework. But really what we're doing is partitioning investments and assets into different risk levels. Personal risk, market risk, and aspirational risk. What I mean by personal risk is consider yourself having a certain amount of assets below which you never want values to slip. Okay? It is an amount that you never want to go below. And I call those personal risk assets. In a way of thinking, if you say that for my lifestyle, I will not accept the value of my investments to go below $500,000, then those assets can be partitioned in risk-less investments, ones that are not going to accept any market fluctuation. It is my baseline. That might include such things as a bond portfolio with bond maturities, let's say, for the next 10 years, equally distributed. So if interest rates go up or interest rates go down, the value is still there. You're just letting them mature. It could include such things as insurance, annuities, but a guaranteed value is what you're after, and you're willing to accept lower returns than you would accept in the other two partitions. So what this is just doing is it's a different way of looking at the risks that are inherent in your investments, not just saying if I have a lot of stocks, bonds, and cash, I'll be okay. It's really saying there's a threshold below which I will not accept my portfolio to go, and these assets are the ones that are going to maintain that. The second would be market risk, and this is probably where we spend most of our life. Stocks, bonds, cash, how do we implement them? What should we own? I'll come back to that in a moment. Aspirational assets is an investment that you might have some personal knowledge of or have some bequest or something that has come about where you don't want to get rid of it. You want to maintain it, and you think it will have the opportunity for extraordinary returns, and you're willing to take the extraordinary risk in that investment. To pick an event, let's say that you have some personal information regarding a pharmaceutical company, and it is public information, and you decide, I think I know that this particular stock is going to do quite well, and I'd really like to invest in it. That's not part of a coordinated effort. It's just saying, I believe that there's a great upside to this, and this is the particular kind of investment. It might be a real estate project. It might be precious metals and so forth. But you're partitioning that risk to say, if it comes to pass, it will increase my lifestyle. If it doesn't come to pass, I haven't deteriorated my lifestyle because the market portfolio and the personal portfolio are able to sustain me. And then lastly, I want you to consider in this taxonomy of what Entrust means is the fact that we usually have upside down what the real issues are in the friction that applies to investments. Most, if we just sat down and talked, would start to concentrate on things. What is the transaction cost of a particular investment? What is the commission costs of the investment? What's the investment advisory costs? And you'll see from this graphic I tried to put together here, between gross and what I'll call realized return, base return, excuse me. The largest is taxes. And that can be estate, it can be gift, it can be income, but by far the largest friction between gross returns and what you put in your pocket are not the transactional costs, the implementation costs, but they're actually, in most cases, they're going to be taxes. So the method that you own an asset is very important, whether that's in trust or partnerships or individually. How you own it can minimize estate and gift taxes, can minimize income taxes. Then there's the cost of implementation. And then another cost that really are not direct unless you happen to have them affect the asset, those would be what I call contingent costs, such as creditor claims, litigation costs, and there are ways by titling assets you can minimize the risk of those assets being exposed to litigation and creditor claims. So again, we're trying to minimize the return. We want to come back and partition the way they're owned. So we have safety assets, we'll call those personal risk assets, and then market assets and aspirational assets. Let me then come back to our outline and go to the second point I'd like to touch on, and that's the who. Who do you entrust? I've broken this down into three categories of these specialists you might consult. One would be yourself. You believe that you're going to make the study of investing and that you can make those decisions. If that's the case, out of these three different methods, I believe there are two derivative questions. One, are you going to do that on your own? Are you the research person? Are you the one to actually delve into the information to make appropriate decisions in the types of investments you'll make? Or will you want to consult someone else? And that's basically in the do-it-yourself category would be you either researching it or you seeking someone who could implement transactions but would also give you research and their recommendation. The first would be more of a discount brokerage activity. The second would be more of a full-service brokerage activity. The second category would be discretionary services. You would know them many times by mutual funds. Mutual funds are discretionarily making decisions on what to own in your behalf. You buy shares in an open-ended mutual fund, and you own an undivided interest in that underlying portfolio. And you then just need to select what you would like that manager or that mutual fund to invest in. So you select the mutual fund, and internally they're going to make decisions for you. The other type of discretionary investment I've listed here is called separately managed services, where you're actually going to hire somebody to manage assets in your behalf, more customized, and own individual securities. So the second decision, I think, or one of these three decisions on who to entrust, is do it yourself, or secondly, hire somebody to do discretionary services for you. And the third is consultative. Consultative would be fee for service. You're going to hire an individual or a firm that will determine what it is you need, as we talked about in the taxonomy of what that relationship should be and your who do you entrust. When you then look at the consultant, you're going to look for somebody that's going to do fee for service, and it's going to create maybe three different issues for you. One, I'd summarize them as this. Those decisions have not an implementation component to it. So when you get the information, you still have to figure out, now I know what I want to own, where do I go to do that? In one case, fee-based investment advisors will give you outside recommendations only. That is, they have no conflict of interest. They're just going to work with those outside. Secondly, there can be kind of a hybrid where they're going to recommend investments outside, but they might also have mutual funds that their firm has, and they're made just for their clients. It's typical in a bank situation where there'll be some mutual funds that they'll have internal and they'll sponsor, and others external. And then lastly, it would be that combination of inside and outside implementation. Excuse me, the second item being only inside, and the third one being inside and outside. To wrap up my session here, again going back to my analogy of the patient in your office with pain in the lower left quadrant and you seeking other specialists as you're doing your diagnostics, I would say that in how you relate to these issues, I think you need to think of either hiring somebody to synthesize all of these specialists and in effect be the chief investment officer for you. That's what I call a conductor, as in a symphony. They're going to conduct the specialists and come to you with a consolidated, summarized recommendation. That can also be a firm that has multiple heads, but basically that's the service. They're going to consult with the specialist. They're going to bring to you the recommendations. The second element would be you would be hiring implementors. You're going to take that position of the conductor. You're going to consult specialists, and you're going to make the final decisions, synthesizing all these pieces. If you feel like you're in that position where you can synthesize the pieces and implement it, that would be the second choice. You don't need the conductor. So I challenge you to think about, after you determine what your financial statement looks like and your needs, whether or not you should be the one to hire a single company to synthesize all that information and make the recommendations to you, or whether you want to keep yourself in that position and consult the specialists and bring that information together for the implementation. The last point I'll leave you with is that it's, to me, very important not only that you never relegate the information to other professionals, but you only delegate to get that information brought back to you. It's also very important that there is an ongoing verification of what's going on. That's my last point here. You need a periodic analysis of what the investments that you're making are, who's making them, and that they're verifiable, that those funds are where they are said to be and what their value is. Thank you.